Ruth, I need to tell you something embarrassing.
Okay, I am listening.
I have not slept well in 3 weeks, and it is not because of work or my kids. It is because I bought a stock that swings 5% every single day. I check it before bed. I check it when I wake up. I checked it twice during dinner last night. My wife is not happy.
Patrick, I am going to ask you one question, and I want you to answer honestly.
Okay,
If you could not check your portfolio for an entire year, no app, no alerts, no peeking, would you be okay with what you own right now?
no, honestly no.
Then you have the wrong portfolio, not the wrong stocks, the wrong portfolio. And today we are going to fix that with something I call the Sleep Test portfolio. It is not about picking the safest investments. It is about building a portfolio that matches your actual tolerance for uncertainty. So you never lose sleep over money again.
Okay, I am very interested. But first, am I the only one who does this? Because I feel a little crazy checking my phone under the dinner table.
You are absolutely not alone. And here is the thing. The data on this is actually shocking every year. A research firm called Dalbar publishes a study called the Quantitative Analysis of Investor Behavior. They have been doing it for over 30 years, and what they consistently find is that the average investor dramatically underperforms the market.
Okay, by how much? Like a little bit?
Not a little bit. According to the Dalbar 30-year study of investor behavior, the S&P 500 returned an average of roughly 9.65% per year. The average equity investor earned just 6.81%. That is not a small gap, Patrick. That is roughly 3 percentage points of annual returns, just gone.
Wait, 9.65% versus 6.81? The same market, the same stocks available to everyone, and the average person left roughly 3% on the table every single year?
About a third. And the reason is not that they picked bad stocks or paid too many fees. The reason is behavior. They bought when they felt excited and sold when they felt scared. They checked their portfolios obsessively. Just like you have been doing, and every time they saw a big drop, their anxiety made the decision for them.
So the anxiety itself is the problem, not the investments.
Exactly. Morgan Housel puts it beautifully in The Psychology of Money. He writes that the highest form of wealth is the ability to wake up every morning and say, I can do whatever I want today. But if your investments are keeping you up at night, you have traded one form of freedom for another form of prison. You might be building wealth on paper, but you are paying for it with your peace of mind.
That hits hard because that is exactly what it feels like. I am technically making money on this stock, but I am miserable.
And here is what makes it worse. The American Psychological Association has been tracking financial stress for years. Their Stress in America survey found that 72% of Americans say money is a significant source of stress. And when they dug deeper, it was not just people who were struggling financially. People with substantial portfolios reported high stress too, because they were constantly worried about losing what they had built.
72%. So basically 3 out of 4 people are stressed about money regardless of how much they have.
Right. And that stress has a real cost. Daniel Kahneman's research on decision-making showed that when people are under stress, they shift into what he called System 1, thinking fast, emotional, reactive. They stop thinking analytically and start thinking with their gut. And in investing, your gut is almost always wrong. Your gut says sell when the market drops. Your gut says buy when everyone else is buying. Your gut is the reason for that Dalbar gap.
Okay, so let me make sure I am following this. The anxiety makes you check your portfolio constantly. Checking constantly exposes you to every little swing. Every swing triggers an emotional reaction, and the emotional reaction leads to bad decisions that cost you 6 or 7% a year in returns.
That is the anxiety cycle, and you just described it perfectly. It is a loop, and the only way to break the loop is not to get better at controlling your emotions. It is to build a portfolio that does not trigger the emotions in the first place.
Which is where the sleep test comes in.
Which is where the sleep test comes in. The sleep test portfolio is built on 3 questions. If you can answer yes to all 3 for every investment you own, you have a portfolio that will let you sleep at night. If you answer no to any of them, that investment needs to go.
3 questions. I like that simple. What is the first one?
Question 1 is the midnight test. Here is how it works. Imagine you go to sleep tonight, and while you are sleeping, the market crashes 40%. You wake up tomorrow morning and your portfolio is worth 60% of what it was yesterday. Would you panic and sell? Or would you roll over and go back to sleep?
For my index funds? I think I would be okay. Nervous, but okay for that volatile stock I bought. I would be on my phone at 3 in the morning trying to sell.
And that tells you everything. Warren Buffett has said this many times. I will never own anything that keeps me up at night, and he means it literally when the market crashed in 2008. Buffett was buying. He invested $5 billion in Goldman Sachs during the peak of the panic. He could do that because nothing in his portfolio was making him lose sleep. He had already built a portfolio he could hold through the worst night of his financial life.
$5 billion during the crash, while everyone else was panicking. That is the midnight test in action.
Exactly. And here is a real-world number that makes this concrete. During the 2008 financial crisis, the S&P 500 dropped about 57% from peak. To trough, investors who panicked and sold near the bottom locked in those losses. But investors who held through the crash saw the market recover completely within about 5 years, and then go on to triple over the next decade. The midnight test is not hypothetical. It is the difference between building wealth and destroying it.
Okay, question 2.
Question 2 is the vacation test. Could you go on a 2-week vacation, leave your phone in the hotel safe, and not worry about your investments for 14 days? Not just tolerate it, actually enjoy your vacation without that nagging feeling in the back of your mind.
Oh, that is a good one, because I literally checked my portfolio on the beach last summer. My wife took a photo of me staring at my phone with the ocean behind me. She was not amused.
And that photo tells you something important. John Bogle, the founder of Vanguard and the inventor of the index fund, had a wonderful philosophy about this. He said, "Do not look for the needle in the haystack. Just buy the haystack." His whole approach was built around the idea that investing should be boring. You buy a broad index fund. You set up automatic contributions, and you go live your life. You do not check it. You do not tinker with it. You let time and compounding do the work.
Buy the haystack. I love that. Okay, what is question 3?
Question 3 is the explanation test. Can you explain every investment you own in one sentence to a friend who knows nothing about investing? Not a complicated sentence. A simple one like, I own a fund that holds a little piece of every large company in America.
I can explain my index funds. I own a little piece of the 500 biggest companies in America, but that volatile stock? I honestly could not tell you exactly what the company does. I bought it because someone on social media said it was about to take off.
And that is the red flag. Buffett has another famous rule. Never invest in a business you cannot understand. If you cannot explain it simply, you do not understand it well enough to hold it through a downturn. Because when the price drops, and it will drop, the only thing that keeps you from selling is conviction. And you cannot have conviction in something you do not understand.
So, the sleep test is 3 questions. The midnight test. Would you hold through a 40% crash? The vacation test. Could you ignore it for 2 weeks? And the explanation test. Can you explain it in one sentence?
That is it. 3 questions. And if any investment in your portfolio fails even one of those tests, it does not belong there. Not because it is a bad investment. It might be a great investment for someone else, but it is the wrong investment for you.
Okay, but Ruth, I can already hear people thinking, sure, boring portfolios let you sleep, but do they actually make money? Because it feels like the exciting stuff is where the big returns are.
Let me put it this way. The most boring investment of the last 50 years, a simple S&P 500 index fund, has beaten 90% of professional fund managers over every 20-year period. 90%. These are people with Ivy League degrees, Bloomberg terminals, teams of analysts, and billions of dollars, and a boring index fund that a teenager could buy, beat almost all of them.
90% of the pros, that is wild.
And here is my favorite example. In 2007, Warren Buffett made a $1 million bet with a hedge fund manager named Ted Sides Buffett. Bet that a simple, boring S&P 500 index fund would outperform a hand-picked basket of hedge funds over 10 years. These were the best hedge funds on Wall Street, the smartest people in the room, and after 10 years, the index fund returned 125.8%. The hedge funds returned about 36%. It was not even close.
125% versus 36. The boring option won by almost 4-1.
And Buffett donated the winnings to charity. But the real lesson was not about the money. It was about the principle. Simplicity and patience beat complexity and excitement almost every time. Bogle proved it with data. Buffett proved it with $1 million bet. And the Dalbar study proves it every single year.
Okay, so boring wins. But let me ask you this. What does the anxiety actually cost in real dollars? Because I think people need to feel the number.
Let us do the math. Say you invest $500 a month for 30 years at 10% annual returns, which is roughly what the S&P 500 has averaged. You end up with about $1,130,000. But if anxiety causes you to buy and sell at the wrong times, and you only earn 3.6% like the average Dalbar investor, you end up with about $517,000. The difference is $613,000.
$613,000. That is what stress costs, not in feelings, in actual money.
That is the anxiety tax, and it compounds against you for decades. Every emotional decision, every panic sell, every time you check your phone at dinner and make a trade based on fear. You are paying that tax. And unlike real taxes, this one is completely optional. You can eliminate it by building a portfolio that does not trigger the anxiety in the first place.
Okay, so I am convinced. The sleep test makes sense. Boring portfolios win. Anxiety is expensive, but what do I actually do this week? Like, give me the practice.
The practice is called the Sleep Test Audit, and you can do it tonight. Step 1. Open your portfolio and list every investment you own. Step 2. Run each one through the 3 sleep test questions: the midnight test, the vacation test, the explanation test. Step 3. Any investment that fails even one test, put it on a watch list. You do not have to sell it tomorrow, but you need to have an honest conversation with yourself about whether it belongs in your portfolio.
And step 4?
Step 4. For anything that fails the test, make a plan to transition it into something that passes. That might mean moving into a broad index fund. It might mean reducing your position size so it is small enough that a big swing does not keep you up at night. The goal is not to avoid all risk. The goal is to own risk you can live with.
Own risk you can live with. I really like that. It is not about being safe. It is about being honest with yourself about what you can handle.
That is exactly it. And I want to leave you with one more thought from Morgan Housel. He writes that wealth is what you do not see. It is the cars not bought, the watches not worn, the upgrades declined. And I would add, wealth is also the nights you slept soundly because your portfolio was not keeping you awake. The calm is the point. The boring is the strategy. The sleep is the reward.
That is beautiful, all right. Let me bring it home with the takeaways. Number 1. The biggest threat to your returns is not the market, it is your own anxiety. The Dalbar study shows the average investor earns about a third of what the market returns because of emotional decisions. Number 2. Use the sleep test portfolio. 3 questions for every investment. The midnight test. Would you hold through a 40% crash? The vacation test. Could you ignore it for 2 weeks? The explanation test. Can you explain it in 1 sentence? Number 3. Boring portfolios win. A simple index fund has beaten 90% of professional fund managers. Buffett proved it with $1 million bet. Bogle proved it with 50 years of data. Number 4. The anxiety tax is real. The difference between a calm investor and an anxious one can be over $600,000 over 30 years. Stress is not just a feeling, it is a fee. And number 5. Do the sleep test audit tonight. List your investments, run them through the 3 questions, and make a plan for anything that fails. Own risk you can live with.
Build wealth with patience, not panic. That is what Calm Investors is all about.
Follow Calm Investors wherever you are listening.